Hello everyone, this is Professor Kent. Today's recording is chapter 6 part 2. What I'm going to do is I'm going to start with what I left off with. So we left off here, and that's what we're going to be starting with the same thing where we left off. Now what we're going to do is we're going to talk about automobile allowance. What is an automobile allowance? Is the allowance that are given to employees for using their own car. So that's what they have. They're given an allowance for using their own car. So I am just trying to see my pen when it comes back. Now the first one is certain automobile allowance restrict the amount employer can deduct as an expense per kilometer paid to the employees. So it's a deduction from the employer perspective, because what they're doing is they're paying a deduction to they're paying to their sorry, it's back, they're paying their employees. So what happens is either can be given as a lump sum, or it can be given on a prescribed amount. So when it's given on a prescribed amount, so the first 5,000 kilometer is 0.70 cents. Anything over the 5,000 they get allowance of 0.64. So these numbers, the 0.70 and 0.60 is the cents that changes every year. So these are the numbers for the year 2024. They do change, the amounts do change. So, and also it changes according to the territory. If you're in Ontario, these are the number for Ontario, but there could also be other territory. They have a different rates according to the mileage the car is driven. Now the other one is interest and property tax on a land. So if you look at it, this diagram is a good diagram. When you're looking at it, you what does that diagram tells you? Is this been, what do we do with it? It's an expense. So of course interest, we want to know, is this interest, is the interest and property tax is deductible or not? Is this an first of all, is this an expense? If your answer is yes, then you go this route. If your answer is no, then you go on the other route. Is this expense has been deducted for the accounting purposes? If your answer is yes, most of the time your answer is going to be yes, because we report all the interest expense and the property taxes on the land. If your answer is no, there is no deduction for it. If your answer is yes, let's say, is this expense made or occurred to purpose of gaining an income or from a business? Then if your answer is yes, then what you're going to do is you're going to go down. If your answer is no, then you're going to go all the way, that you are not going to have a deduction. But if your answer is no, then we have two type of deductions. One is under the 18, one is under the section 20. So if your answer is yes, then you say, is this expense denied by, so was that denied means according to this IT 88, were you not allowed to deduct this expense? If you weren't allowed to, if your answer is no, then what we have to do is you have to go in, then you have to look at it. Is this expense a capital nature? If it's a yes, you go to 20. If it's not a capital nature, it will be deducted subject to other reductions. So we're going to have other restrictions. So you could have a yes and a no answer. When you have a yes and a no answer, you needed to follow the lines when you're doing that. So go through this. What we did was that, is this expense is allowed or not? Mostly if it's not allowed, then that means it was not an expense. It wasn't for the account, you wouldn't record it under accounting purposes. If it's not recorded, you will not be allowed to make any adjustment. From there you have to look at it as a capital nature, or what kind of nature is it. If it's a capital nature, it'll be restricted. If it's not capital nature, then you'll be allowed to do a deduction under the IT 20. Home office expenses. What are the home office expenses? If you have an office at home, that's what it means. You are using part of your home as an office expense, and you are allowed to deduct some of the home expenses. When you think that expenses are limited where workspace is situated in a home which the individual lives in, or is used for taxpayers purposes. Workspace expense cannot create or increase it. So you cannot just create expenses to increase a business loss. We will not let you do that. But if you do have a business loss, you're allowed to carry forward it. First of all, you cannot create or increase your business loss when you're recording your expenses for your home office expenses. You cannot create them or increase. If you already have a loss, you cannot increase the loss. Now if there is a business loss, in the if you have expenses and that created your business loss, that business or in the year but carry forward is allowed if the space continue to meet the test of deductibility. So we are allowed to do that if it meets the deductibility test. Otherwise you're not allowed to you're not allowed to carry forward the loss. Now how you determine which part is your home office expense and which part is your total space? So when you look at that, you look at it the total space, and then what we're doing is what you're dedicating. So if you have, let's say, 4 rooms in your house, and you're using one room as an office expense, so the total rooms were 4 and then you're using half of the expense. If you're I'm just going to do it with pen. If you're using one room, so then you're allowed to deduct 25 of the expenses. So this is where this is coming from, is your I don't know what happened to my my pen. It is not coming back. So it's a dedicated workspace. That means we dedicated one room, and then this is the total space. So this is the first one is your workspace. This is the total room that is dedicated. Common area used throughout the work day. You could also have it in your living room or in the family room or in the kitchen, the office. So, and then we are looking at the amount of time during the work days common areas used to compare to the total working hours. So you have to, if you don't have the specific room that is assigned for your workspace, then you have to do these calculations to deduct some of the expenses. So there we go. I got my pen back. Now the deductible costs. What are the expense? First we need to look for it, determining the workspace, what percent you're using. Then you're looking for the expenses appropriate between the personal and the business. So you have to separate them, what are personal and what are separate. CCA is not generally advisable, so we don't do CCA we don't record CCA as a work home expense. Now if you look at it, these are some of the deductibility for the home expense. Now what we have is, if you're an employee and you're using the home office expense, that means you're not going to have a commission expense. You could be an employee where you have a commission expense, or you're self-employed where you're a sole proprietor business income. Now if you are renting it, it is a it is a deductible expense. Utility is a deductible expense. Any repairs to the property or to the house is a deductible. Now when we think of a telephone and internet, it is a yes or no. When we think of a yes, it's a sole proprietorship. Both are deductible. When you are with the commission and with your it's a yes and a no, it's only going to be proportion of your expenses. You have a property tax, it is not. If don't have a commission, it is not deductible. But if your commission, it is these two are deductible. Same with the insurance. So no CCA, no mortgage and trust, no home office home insurance. So if you have a home insurance, however, if you have a commission, you are extra. These two are my extra deduction. If you're self-employed, everything is a deductible expense. Everything is a deductible expense. Now when we think of an inventory, that goes on your balance sheet, and we do a when you think of an accounting, we record a lower of cost, or we used to call it net realized value, but in income tax we call it fair market value. So lower of cost or fair market value. what we use, if accounting use a lower of cost and net realized value. So what we do is we need to find out the fair market value of the entire inventory in order for you to do the valuation. And then what we're doing is, this is just telling you what fair value method, fair market value. You have to record your inventory at a lower of cost and a fair market value. You will be doing an adjustment, and that adjustment you're gonna is a write-off from the purposes of tax. Now when we do an inventory, when we do calculate the ending inventory, under accounting we use specific identification, average, and a FIFO, or a retail method. We used to have a LIFO. LIFO is not used for tax purposes or accounting purposes anymore. It used to be used before, but now they're not used anymore. What are we going to look for? It we're looking for an ending inventory. This ending inventory is on your on your income statement. If it's not on your income statement, we need to do an adjustment. When you do an adjustment, we do a lower of a cost or a fair market value. That will be the adjustment you will make to the income statement for the tax purposes. CCA is allowed deduction. If it's an allowed deduction, you needed to know where the asset sits so you can write off your expense. If you are incorporating a business, means you are going to incorporate your business, you are going to pay for articles, you're going to pay everything. So what they incorporation of an expense goes under the class 14.1. It is a deduction that you're allowed. Now, simple interest. What we do is, a company, when it's a business, what they need money, and they borrow that money from the bank or from an investor. So what they do is, when they borrow money, what they're going to pay is they're going to pay interest to this person, whoever they borrowed the money from. If they're paying interest, that interest is a deductible. So that's interest is a deductible expense. So it is our deductible expense. Now going further, now these are my financing costs. So what happens is, financing cost is also a deduction, and it is under IT Income Tax Act 20. If it's a deduction, what we do is we do it on a straight line basis. If you're doing a straight line basis, then you do it over the 5 years, or we could do it 20%. How did we get a 1 over the 5 multiply by 100 will give you the 20%. So that's what we're looking for. What are the what are some of the financing cost? Example could be legal fees, printing cost, guarantee fees, mortgage application, brokerage fees. These are all comes under the financing expense, and you can write it off over the 5 years under the income tax. Now, if it's an annual fees that you paid for financing, so we call it administrative fees that you do. So it is fully expensed in the year you file, rather than spread over the file, because the annual fees could be $100, $200, or whatever the annual fee is for that. Then it is it is fully deductible in the year that it happens that you apply for financing. So these are some of the example of your financing costs. When we think of a premium, life insurance premium, life insurance cannot be expense, because what happens is, the life insurance, it is not a deductible. If it's not deductible, because if something happens and you an individual gets a insurance from the life insurance, that means we don't pay taxes on the money that we receive from the insurance company, and the government will not allow to deduct the insurance expense. Going further, we have a discount on a debt obligation. So you have a long-term liability. Long-term liabilities are bonds, debenture, notes, and mortgages. Now what happens is, when you have it, we have a discount. So the bonds are discounted. If they're less than 100, they're discounted. If they're more than 100, there will be a premium. So this applies to discount when it's a deduction of a full amount or 50%. It depends on if the bond was issued at less than 97 of the maturity value, and effective yield not more than 4/3 of the coupon rate. When we what we do is we have a present. If you think of an accounting, we have a present and you have a face value. If the present value is lower than the present value is lower than the face value, then what we have is we have a discount. And if it's a discount, we needed to know if it's less than 100, it's a discount. If it's more than 100, it will be a premium. But if it's up to 97% deduction, the full amount for, or only 5%, depending on this criteria. So depending on this criteria, every criteria will be different depending on the bond, what the discount rate is. It could be 98, 99, 97, but if there's a less than 97, then it depends on these two criteria. Going further, employer contribution to RPP, in other words, retirement pension plan. What they do is employer, what they do is they are allowed to deduct it. The employer is allowed, it's a deduction for them. It is permitted a taxation year where the actual payment by the employer is made to the plan within the tax year. So whenever the employer makes the contribution and the year the actual payment is done, you are allowed a deduction, similar to sort of a bonus. Now this is also employer contribution to defined pension plan. So it is deducted. It is also part of the pension plan, but it is deducted if paid in the taxation year. Only if it's paid in that taxation year is allowed to deduct it. Now what happens is most companies, what they do is they lease their assets. So if they lease it, cost of cancellation of a lease deducted on the prorate basis over the remaining term. So you have a lease, it could be a rental lease, it could be any type of lease. If you decide to cancel that lease, and if you like to cancel this lease, it will be you are allowed to deduct it. However, it will be deducted will be on the prorate per team basis over the remaining term. So if the term was 10 years, you cancel it after the 4 years, the remaining life is 6 years, and that will be your deduction for the lease cancellation. Landscaping must be paid in the year that we are doing the deduction. Now, expenses for representation. So what happens is there's a lawsuit. Maybe if there's a lawsuit, the amount you pay now. This is not a lawsuit. Sorry, I was thinking of something else. But this is, in other words, it's for the patent or franchise. In this case. So we are obtaining a license or a permit or a franchise or a trademark. So what we need a lawyer to do the paperwork. Now we are allowed to deduct it. This is amount paid in the year that the amount is paid. That's the year we allowed to deduct it. I was going to go to the patent. So CRA allows you. Of course, we pay the lawyer. We have to defend our patent. We develop a patent. We don't want anybody copying those patents. So what we wanted to do is any payments that we made, we capitalize it and we write it off. If we write it off, it becomes an expense from the perspective of income tax. Site investigation costs. So preliminary investigation cost for suitable building site. You send somebody to see if this area was good to build a building. So that's a preliminary investigation. That is a deduction. Utility services connection. Of course, if you develop a building, you need utilities to run your building, and that is a deductible in the year is paid. Disability related cost. deducted in the period it is paid. So what happens is you are going to hire somebody, and if you're going to hire somebody, they have a disability, you have to provide them you have to have an elevator or some other type of other expenses, other type of equipment or devices. Those are all deductible in the year they are paid. Convention expense. So what happens is that convention is you send yourself or your employee to the convention. So what you're allowed to deduct it, but you can't just keep going yourself to the conventions. You're only allowed no more than 2 in the single year. Now you can't say, if your company is in Ontario, saying that in the location consistent with the territorial scope. If you're going somewhere else, then they're going to say you're not going to be earning any income when you go to the other territory. It has to be consistent with the territory of your business. Meals and entertainment only allowed is 50%, only 50%. The rest is not deductible. Reminder is lost. There's no carry forward for the meals and entertainment. These are some of the things that goes under the meals and an entertainment. Now we have a automobile cost. So we did look at the CCA perspective of it from the last chapter when we do it. However, we could have a luxury automobile expense. When you have a luxury automobile cost, restriction on expense to the employer for the CCA, lease payment, and the interest. Now, calculation of taxable benefit to employees is based on the actual cost, if luxury vehicle or not. Employer expense related to CCA, lease payment, and interest restricted if it's a luxury vehicle. So if it's a luxury vehicle, the government, what they do is CRA restrict your expenses for your CCA purposes, lease payment purposes. So these are the prescribed rate that we were talking about. These are the prescribed amount for your automobile owned by the taxpayers. So this is 37. If they go under class 10.1, you can take a CCA. Is 61 plus the HST is zero rated cars, automobiles. Note now this is GST and HST is recoverable as an input tax credit. So what are we doing is we have a GST and HST. What we do is, if you're in Ontario, we have an HST. If you were in another province, you might have a GST and a PST for that province. So then we were going to use GST that we paid is recoverable as an input tax credit when we file our HST return at the quarterly or semi-annually or annually. We file an HST return. This HST is a recoverable. So this HST is recoverable. Next we have interest limitation, which is lesser of the interest paid, or 11.67 per day that we use the car. So that's per day that the car is being used. Now if we can own the car, or we can purchase the car, or we can lease a car. If this is the purchasing the car, and this one is leasing a car. When you are leasing a car, the prescribed amount is $10.50. This amount changes every year. This amount is according to 24. This amount changes every year. So this times the number of months the car was leased, or the automobile was leased. Now this was the sort of the rate that we use. This was the formula we used for the standby charges. So this is similar to the standby charges, exactly the same thing. One could be owning the car, one could be leasing a car. So fines and penalty, in other words, they are not prohibits the deductions. We're not allowed these deductions because we're paying the fine. It's our fault. We're paying a penalty. It's our fault. So if you doing that is, if these are deductible expense from the perspective of accounting income, but they are not deductible under the income tax, so then you have to add back. Sometimes what happen, we have a taxation year, so a corporation can use a fiscal year, or it, as long it does not exceed the 53 weeks. They're allowed a calendar year or a non-calendar. What is a calendar year? From January to December is a calendar year. Non-calendar year will be anything other than the calendar. You can have a let's say March to March, April to April, June to June, August to August. That's what it means. Now we also have an income from farming. So if you are a full-timer farmer, business losses are fully deductible because that's the only source of income you have. We have a part-time farmer, losses are restricted, involved in farming business but not the main source of an income. If it's a hobby, no income, no losses for that. Now when we think of when we think of farm loss is restricted into two: unrestricted farm loss and a restricted farm loss. We normally don't question too many. We don't normally question, ask students too many questions on farming loss. So in this case, we have two type of losses. We have unrestricted and restricted. When you have it, this is the loss. This is if your loss is between this, then it becomes a farm loss. And then if your loss is between this, you take the first 25 plus the 50% of any above. The maximum loss under restricted you're allowed is 17,500. So now the restricted loss is whatever you did here, then you cannot, it's the difference between the total farm loss minus the unrestricted loss, and that will be your deducted against the future. So if your loss is more than, let's say 17,500, you'll be carrying forward that loss in the future against any profit. Sale of a business: when you have a disposition, you sell a business comes to an end, no longer any source of income. The company is not, the business is not making any money. So what we do is we sell that business. If we sell that business, it will be a sale of an inventory, and because if it's a sales of inventory, any gain is fully included in the business income. Any loss you have is fully deductible. So you could, now how do we calculate the gain? The cost was $10,000. We of course at the end we sold whatever was in there. We sold it for, let's say, $50,000. So then we have a 50,000 loss. Loss is deductible, but you could also have a gain. So in other words, how you're gonna get the gain? Your business was worth 100 and you sold it for 150. Instead of a loss, we have a gain of 50,000. We pay taxes on the gain, and loss is a deductible expense. And this was part 2 for lesson number 6, source of income. I'm going to try to record some questions at the back of the chapter so we could learn the material that was learned in the chapter. Thank you so much for watching me. Don't forget to subscribe. Don't forget to tell your friend to subscribe to my channel, and don't forget to like or provide a comment on the video. Thank you so much. Take care and bye for now.